These are the 10 top best stocks to invest in right now. This is probably what you're used to seeing on social media. Now, why doesn't this work? Well, the problem is the top 10 best stocks for someone to invest in may not be the top best stocks for you to invest in. And that's because personal finance is personal. You have a unique financial situation and financial goals, which means what you invest in is going to look very different from someone that comes from a different financial situation. After helping over 100 plus clients learn how to invest their own money, all of them invest in different things because each of them come from a different financial situation. And this is probably why you still feel really confused when it comes to choosing the best investment, because you don't know how to actually choose the best investment for your specific financial situation. And so that's the reason why in this video, I'm going to share the 3 steps that you need to take to choose and evaluate the best investment for your specific financial situation and goals. Let's get into it. Okay, so the first question that I always get asked is, Michael, what should I invest in? But asking this question is like trying to build a house starting with the roof. You'll end up with a house that's pretty janky. If you want to build a solid house that actually works, you need to start off with the foundations first. And that's the reason why the first question to ask isn't what is the best investment, but instead the first step is to ask, what are the financial goals that I'm investing for? The reason for this is because what you invest in will be entirely based on your financial goals. For example, what you invest in to buy a house will look completely different from how you invest for retirement. Why, you might ask? Well, it's because of the time horizon. Your time horizon is how long you plan to invest your money. And your time horizon is what directly impacts the amount of risk that you're able to take. Let me explain. One of my clients was investing her money and she got really scared when the stock market went down. But then I asked her, okay, when do you actually need this money? And because she was investing for retirement, she didn't need this money for another 30 years. And that's when she realized, oh, because I'm so far away from my financial goal, I can actually take more risk now. Because even if the stock market goes down in the next few years, it doesn't matter to her because she has the time to wait until the market can recover. But let's say if she was investing her money to buy a house within 1 year. Well, if her investments went down, then that means that she probably wouldn't be able to afford her house. And yes, I would be stressing too. And that's the reason why for long-term goals, you can take more risk because you have the time to wait for the market to recover. But for short-term goals, you can't take that much risk. And just so you know, when I mean higher risk investments, I don't mean by gambling your money in crypto or the next meme stock on Reddit. What risk means when it comes to investing is volatility. What volatility means is how much a stock goes up and down. And if a stock is more risky, then this stock has a higher potential for return and also a higher potential for risk. While investments with a lower volatility are a little bit more stable with a lower return, but also a lower risk. And that's the reason why the first step to choose the best investment is to first figure out what are your financial goals. You need to figure out when and how much money you'll need to achieve this financial goal. And the key thing is that each of your financial goals should have a separate stock investment portfolio and investing strategy, because each of your goals will probably have a different time horizon. But I'm curious, what are your financial goals? Let me know in the comments below. Okay, so now that you've actually set your financial goals, what should you actually invest in? Should you invest in Apple, Tesla, Google, or something else? Well, let's take a step back. The entire stock market on average has an annual rate of return of about 7 to 8% per year. And a common mistake that beginner investors make is that they try to invest in a bunch of random individual stocks hoping to beat the market, aka do better than the 7 to 8%. But let me share why this strategy has a very low success rate. The truth is, it's really hard to beat the market. There's a New York Times article that states less than 10% of financial advisors are actually able to beat the market. And these are people who have years of experience and knowledge trying to understand how financial markets work. And that's the reason why, unless you're some next level genius investor who can somehow outperform over 90% of financial advisors, your goal shouldn't be to beat the market. Instead, it should be to match the market. Matching the market means that you just want to track the stock market and make an average rate of return from your investments of 7 to 8% over the long term. A somewhat funny but also depressing story is that in my stock portfolio management class in university, we conducted a live experiment where we invested $100,000 of fake money into the stock market. And we spent the entire semester trying to build the best stock investment portfolio based on all of these complicated formulas and metrics that we've learned throughout the program. And the results were quite disappointing. Only about 5% of the class was able to beat the market, which means 95% of us would have ended up with more money if we had just tried to match the market instead of trying to beat it. And that's the reason why, if you're a beginner investor who doesn't want to spend hours trying to learn and study all of these complicated formulas to choose the best stocks that may not even work, your best bet is just to match the market. And so instead of trying to buy individual stocks to beat the market, what you should probably do instead is to match the stock market by buying all of the stocks. For example, the S&P 500 is a stock market index that tracks the top 500 largest US companies. And if you just buy one ETF that tracks the entire stock market, now you equally allocate your money to the top 500 largest US companies. And by doing this, you can expect a 7 to 8% rate of return on your investments over the long term. Okay, so now that you have your financial goals and that you know you should be trying to match the market through exchange-traded funds, which ETFs should you actually choose? Well, this is where a lot of my clients actually get stuck because there are thousands of ETFs to choose from. And so let me give you a little analogy to make this a lot easier. Choosing which ETF to buy is kind of like buying a white shirt on Amazon. There are a bunch of different companies selling the same white shirt with the same design and the same material. At the end of the day, it's a white shirt. So at the end of the day, it doesn't really matter which white shirt you buy because they're all essentially the same. And this is very similar to ETFs. Vanguard will create an ETF that tracks the S&P 500. BlackRock will also create an ETF that tracks the S&P 500. At the end of the day, the ETF will perform pretty much the exact same because it's tracking the same thing. So don't overthink it too much. And so the exercise that I get my clients to do is to evaluate between 5 to 10 different ETFs based on about 5 main criterias, and then choose the best ETFs based on their unique financial situation and goals. The most important criterias of ETFs are number 1, historical performance. And so this is the past performance of the ETF. Now, historical performance isn't necessarily a predictor of future performance, but it's the best metric that we got. When it comes to historical performance, I like to look at the 1-year, 5-year, as well as 10-year return of the ETF. The second metric that I want to look at is MER, also known as Management Expense Ratio. This is the fee that you're paying for someone to manage this ETF. And compared to mutual funds with an average MER of about 2.5%, the average ETF MER should only be about 0.5%. And so as long as it's around this benchmark, your ETF looks pretty good. The third metric is industry holdings. So what sort of sector are you currently in? If you're investing in the US through the S&P 500, you're naturally going to be exposed to a lot of tech companies because that's where all of the big tech companies are, like Google, Microsoft, etc. Meanwhile, if you're investing in the Toronto Stock Exchange, which is also a market index, you're naturally going to be exposed to a lot of financials and energy. The fourth criteria is dividend or distribution yield. This is how much passive income you can expect from this ETF, whether that's through dividends or interest. And lastly, you want to look at asset type. What is the underlying investment? Is it a stock, bond, REIT, real estate? You want to know what this ETF is invested in. And now I know that this might feel really overwhelming because yes, at the end of the day, there are a lot of different ETFs. And the really difficult part is choosing the best ETF for your specific financial goal and situation. But if you want my eyes on your specific financial situation to help you build out an investment portfolio and investing strategy to achieve your financial goals, then apply to book a free financial assessment with me. Every few months, I open up some spots and we always sell out. And so if you want to apply, then just go to michaelleekim.com/assessment. The problem with social media like Instagram, TikTok, and even YouTube is that at the end of the day, the videos that you're watching are just information. And the problem with information is that number one, it's very overwhelming when you have a lot of it. And number two is that it doesn't teach you how to actually apply the information to your specific situation. And so instead of trying to search and research what is the best stock for me to invest in, what you should do instead is learn how to evaluate and research the best stock investment for your specific financial situation and goals. And once you do this, you won't have to worry about, am I invested in the right thing, or I hope this works, because you'll actually know why you're investing your money in these stocks. And so if you want to learn how I'm investing my own money for an early retirement, then watch this video right over here.